Where'd you get that background? Was that just a normal thing?
Um, I found it, the old internet.
Oh, okay. I'm trying to
Yeah,
get this.
it's,
Okay,
I'm not taking credit for it.
I think we're live now, I think, pretty sure. Trying to get this. There we go. We're getting the reverb. So I made this in Canva. This is actually a template from Canva, and then I just put my name on there, my email address. But isn't it
Wow.
great? I'm an angel.
Is that how
You
you
already
get
knew
around
it.
to all your showings? You just fly around?
I just fly around. I actually had another thing chosen that was pretty. I changed my mind on that. Anyway, so the week has been nuts for me. But busy, positive, then everything falling apart. Positive, then everything falling apart. Positive, then everything falling apart. How about you?
Yeah, that's how it is.
Yeah.
An emotional roller coaster.
So emotional, and not just for our clients, sometimes for us too.
Oh, yeah,
Of
definitely.
course. Of
All the
course.
way around.
And so Matt Tonkin, obviously, Maple Tree Funding. We're here with the lowdown. And anyway, we talked about what we were going to talk about this week. We talked about what we were going to talk about.
We talked
Eh,
about it.
We talked about it and we said, what are you guys' thoughts on investing? I know that in my circles, I
In
have a
real
lot of
estate,
people,
investing in real estate.
not like young like you, but anyway, I have a lot of people that are thinking about where are they going to be putting their money? Where can we have our money grow? I don't want to say later on in life, but we'll say we're mature. And
Yeah,
real
it's for
estate
any
is
time.
real estate is the best. And my son, Jake, he's 25 now and he is living at home banking his money because he's going to be buying a two family because he wants to start investing in real estate. And so, unlike stocks, which fluctuate in value, real estate is a safer, more consistent return. And it's a buy and hold investment. So you buy them up, when the market is getting right, which is heading that way. Right now, I feel like it's a great time to buy investment properties. They're more consistent returns, they're buy and hold. And so I thought great time for us to talk about some investment lending programs that I do hear a lot of people talk about. And maybe some people want to know more about the investment programs out there. And so I'm actually going to, we had a little schedule and I'm going to change that schedule around a little bit because, I got to keep
Oh,
you on your
perfect.
toes.
No problem.
But I
Get
know a
my
lot of
chalk
people,
ready.
right.
Let's
And I know
see.
people, just fill it all out. I love it. Just keep filling it all out. You're a genius. Your
Well,
IQ must be over 75.
over what? 0.75? Yeah.
75.
Yeah,
Must be
0.75.
over 75. Um, So anyway, let's talk about, I think this program I think is going to appeal to a lot of people, and that is the non-qualified mortgage products, which
Hmm.
people call hard money or they call hard lend. And so let's open this up a little bit for them. And
Yeah,
again,
yeah,
this is
they
called a
can call them, whatever they
non-qualified
want.
mortgage
Yeah.
product.
But yeah, so, well, I mean, non-QM is a general term. It's basically anything other than a qualified mortgage. A QM is qualified mortgage, which
Right.
is your standard conventional mortgages for primary, secondary investment property homes, through Fannie Mae and Freddie Mac for the most part. FHA loans, VA loans, USDA loans. Those are all qualified mortgages, which basically means they meet the regulators' requirements for the ability to repay, which is a requirement for lenders to verify, and lend based on the actual ability, not you know, maxing them out, stuff like that. And also making sure they don't pay too much for closing costs in a mortgage. So there's a bunch of tests and stuff that get run, but it's so basically the non-QM is stuff that falls outside of the regular conventional and regular programs, which are more geared towards self-employed people, for the most part. And non-QM basically means you actually still have to prove the ability to repay, but there's less stringent guidelines for qualifying for. For single primary homes, secondary homes, and investment properties. So same categories, different criteria. Mostly, well, not mostly, but mostly geared towards self-employed people, because qualified mortgages, you need to qualify them usually based on their tax returns, maybe for the last year or 2 years, depending on how long they've been in business and the type of loan. But there's different options with the non-QM. So you can qualify them based on their bank statements for the last 12 or 24 months, which tell a different story sometimes than their tax returns, right? Tax returns, you always hear self-employed people having trouble because their tax returns, they don't have enough on their bottom line, let's say, to qualify. Okay. So they have trouble getting qualified for mortgages, maybe not for other things, but mortgages. So, a bank statement program or a profit and loss program will allow the lender to evaluate their income for qualifying more accurately than their tax return, which, they're usually two different numbers. They might be close sometimes, but it usually tells a different story and allows them to qualify for more or qualify easier.
So let me stop you right there. So someone like myself, I'm a 1099, subcontractor. Would something like this, would I be able to qualify for something like this? I mean, I'm sure I could qualify for a traditional loan, but is that something, I just sort of want to unpack that.
Yeah, it could be. Yeah, I mean, it depends on, what, inflows and outflows you have. I mean, your inflows are your, real estate commissions. Right. And your outflows are, whatever, marketing, advertising, stuff
right,
like
my
that.
business expenses.
So, yeah, I mean, it depends on the lender. They all have slightly different guidelines and stuff, but it's based on, mostly the deposits in, your business account or personal account, depending on, how right. It's evaluated. So there's a number of different ways to look at it. Bank statements are one. You can do a profit and loss statement for the last 12 months or 24 months, which show, the actual, money in, money out, which also would tell a slightly different story than the tax returns. And there's some other programs like verifying 1099 income as just, gross income instead of, usually with a 1099, you're a contractor, independent contractor of some sort. You file a Schedule C. Yeah. Usually, and you have expenses and stuff. So they'll actually look at your gross 1099 income, use a certain percentage of that, maybe 90% of the gross amount to qualify, instead of the bottom line from your Schedule C, which may be, sometimes I've seen as low as they've had a zero bottom line, or maybe that's 25% of their gross income that is on the bottom line of their tax return. So it's better way to qualify, because we all know how self-employment works. Right. So a lot of options. Okay. But it's some in particular that I think are, beneficial, and, stop me if you have any questions, Janet. But, of course I will. But I think what I really wanted to touch on today was the investment portion of it. Right. Well, I know we were going to go into that. It's just sort of wanted to talk about that a little bit, because I was intrigued by it, and so I wanted to know a little bit more about it. But now we're going to be talking about the DSCQWXYZ. What is it? ABCD. Yeah, no, the DSCR. DSCR. I got some of it right. Yes, the D. The DSCR. What does that stand for, Jan? I think it stands for, I do have it written down in my notes, of course. It's, or no, I don't. I know it has to do with your debt and your credit. Yeah, debt service coverage ratio. Okay. Debt service coverage ratio. Yeah. These are mortgages are strictly for investors, or, investment properties, purchases, refinances, cash outs. They are based on not your personal income, like, W-2 income. They don't evaluate any of that. They only evaluate based on the cash flow of the property,
Right.
right? So they look at the market rent of the property, when the appraisal is done, and then they divide that by the total mortgage payment, the PITI or PITIA with an
So I'm
association.
going to stop you right
Principal,
there.
interest, taxes, insurance.
Let me stop you right there because I did have a conversation with a client last week about what does a bank use for occupancy? And so I said it's not 100% occupancy. I think it's like 83% occupancy for that income. Is that correct?
So, well, like a conventional loan, let's say, they will use 75% of the market rent from the
Okay.
appraisal for qualifying for a primary or investment property. For a DSCR loan, it depends on the lender. They all have different requirements. So they typically use, and again, they vary, but 100% of the market rent.
Okay.
Some use a vacancy factor, but usually
So
100%.
it's a little bit more relaxed than say
Yeah, it's all
conventional investment.
calculated to some degree, by the
Right.
investors. But yeah, that's the way that they do it. And like basically if the property is cash flowing, it's cash flowing, either exactly where the rent is the same as the total mortgage payment. That's a 1.0 ratio, right? So it's cash flowing dollar for dollar. If it's higher than that, it's the lenders like it more. It's a better cash flow. Like if the rent's higher than the PITI,
Okay.
that's good. And you sometimes get better rates, a lot of price better based on a higher debt coverage ratio. And then some will even allow the property to negative cash flow. So it could make less money a month than you're actually paying. And they'll charge for it in interest rate appropriately, but they will do it.
So shifting, and you talked about interest rates. So how are these, and it's probably a very ignorant question, but there are no ignorant questions. Are
Understood?
there interest rates on these investment loans, these DSCR? I know you're impressed. Do their interest rates, are they different than they are in a traditional like residential resale?
Yeah, they're from private investors or private mortgage companies. They're not through the Fannie Mae, Freddie Mac,
Oh, okay, I
channels.
didn't know that. So these are
Yeah, so they're
non-qualifying.
private companies, usually through private equity firms or something as the investor on the back end. So they have certain lending requirements, but the rates vary greatly depending on
Okay.
the loan to value ratio, like how much you're putting down, credit score, whether you're going to take a prepayment penalty because they're permitted on these because they're business purpose loans. So you can, get a lower rate if you take a longer prepayment penalty.
So are
Um,
these also considered a non-qualifying lend?
yeah, technically, I think that's a category that a lot of lenders put them in. It's not
Okay.
QM,
That's
because they're
I think I missed the
not
grading point
QM
on that.
and business purpose. You can, they're strictly for investment though. You can't live in them. You actually sign something at closing usually that says you're not going to live in the property at any time, right? Because it's business purpose. You can close in the name of an LLC, which
Okay,
is a cool feature, which
that's
a
good.
lot of people call about asking if
Well, I mean,
they can buy it in their
you
LLC, and
gotta
you
put
can.
yourself in an LLC.
What's
Anytime
that?
you have to put yourself in an LLC, and we're gonna transfer over to the fix and flips now because we're running out of time. But it's like
Right.
even my flippers, I
DSCRs
always
though,
say LLC.
right? Yeah, DSCRs though, you can do 1 to 4 unit residential, 20% down usually.
Okay.
And then some companies like I have, you can do more than that, multifamily, 5 unit to 9 unit on the DSCR usually, maybe up to
Okay.
10, depending on the lender. There's a lot out there. They usually require 30% down. So, that's like five over 4 units is considered multifamily, category. It's apartment buildings essentially.
Okay.
So, yeah, great product. Do a lot of them these days. They're very easy too. I don't need your income docs or anything like that. So
Okay.
Yeah.
Ace is in the room. He's like barking. Sorry.
Ace is in the house.
He's in the room. I had to drag him in my bedroom. Anyway, we're running out of, who cares about all that? We're running out of time. So I want to talk about those fix and flip loans.
Yeah. Yeah. No,
Let's talk about that.
great
I
product.
just
Yeah.
went under contract with an investor that's getting ready to do a fix and flip. And so that's why the LLCs are important. It's important to give all that information over to your realtor, your articles of, your articles of cooperation,
Organization. Yeah. Get your
organization, all
entity
that.
docs out. Yep.
And so what
Put a
kind
good
of
standing.
options are out there if somebody's like, "Hey, I want to start getting into the fix and flips." How would they go about doing that?
Yeah, I mean,
Money-wise.
talk to a lending professional. Sometimes there's well, they have different categories of it based on your level of experience. First time experienced investor, experienced investors get more, more beneficial terms, less
Mhm.
money down. For example, if you're doing a flip, you're buying a property for $100,000. With an experienced lender, they'll let you borrow up to 90% of the purchase, basically 10% down on the purchase price. Then they will finance up to 100, typically up to 100% of the renovation costs, based on your estimate and what you're going to do. And then it's a 12-month interest only, bridge type of loan where
Right,
you
get
draw
bridge loan.
back on it. You have to do some work, get it inspected, get some money back from the lender, to draw up your balance. So
So
it's
are
a
you
bit of a,
essentially taking draws like as you go? You're going to take a draw as
yeah, you
cash
have to do your own
purchase?
work, pay for the work yourself. You have to have the money to do your work, and then be reimbursed by the lender. So
Okay.
you get an increased balance as you go. Okay,
Okay.
so then when the term is over, 12 months, for example, you have to get out of it. You have to refinance to, permanent financing, or if it's an actual flip, sell the property by then.
Right, right. And so I just to be clear, because I probably missed that in the beginning, can you get a draw from it? So when you're buying the property that's going to be, renovated, are they allowing you like the cash as a draw on that loan for the cash, so you can pay cash for that investment?
So you're at closing, you are going to get a loan or a disbursement for 90 up to 90% of the purchase price. So you have to make
Okay.
10% down on the purchase price at closing. If it's 100,000, 10,000 down payment, they're going to give you 90K for a loan, or as
Okay.
part of your loan. And
Okay.
then as you do work, up to 5 draws usually, you do 10,000 of work, have it inspected, they send you 10 grand,
Okay.
then you draw it up until it's the project's done, and you either flip it and you sell it, or you can refinance it to permanent financing and keep it as an
Okay.
investment for yourself.
Okay, good. Well, a lot of information in
Great
a short
product.
amount of time. And so I'm going to say I'm going to be uploading these to YouTube as well. And so if you're watching this on YouTube, hi, this is our first time. Please make sure you like and subscribe so you can keep checking these out. But I'd like you to comment on Facebook or wherever you're seeing this if you want to know more information about one of these products, or if there's something that you want to talk about in real estate or in lending. Please put a comment. I want to make sure that we can give you real information, realistic information, and we're not, putting lipstick on a pig and whatever. But
Yeah.
it's like we want to talk real talk. We want to talk money for you and your family, and we want to talk what can we do to achieve whatever real estate goals that you have. So I'm
Yeah.
Janet Glaude.
Yeah. Yeah. And just as a note, these products change all the time.
Yep.
Right. So like what I say today, I get updates all the time. They're changing their lending guidelines, down payment, their other requirements. So, just want to say that. And Matt Tonkin, Maple Tree Funding. And
That's right.
thank you,
And if
Janet,
you
for
want to talk
having
to
us
Matt
on.
directly and you're like, screw you, Janet, I just want to know about the money right now, they can search him. You can search him out on Facebook and send him a direct message. No problem. Matt Tonkin. It's pretty easy. Tonkin, AKA the Tonk. Tonk. Anyway, buddy, it's great to see you as always. And we'll be back in a couple weeks. Happy Valentine's Day.
Yes. Happy Valentine's Day.
Oh, yeah. Heart. That's so gay. Anyway, I didn't say that. Happy weekend, everybody.
Thanks, Janet.